Okay, so we have JL Collins here with us in the studio today, and we're going to be doing part 2 of the stock series. For those of you that have just found the show, first of all, welcome. My name's Jonathan Mendonsa. I'm your host. With me as my co-host is Brad Barrett. And if you would like to hear the first part of the stock series, that would be episode 19, and also the associated roundup 19R. So definitely listen to those if you haven't already. Today, I am thrilled to get a chance to explore this game-changing article series with you. So without any further ado, welcome to the Choose FI Radio Podcast.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
Well, we're back. Welcome to the studio. How you doing today?
I'm doing great, and I am really honored to be here.
Well, we are thoroughly excited to have you. I know this is a conversation that we've been wanting to have for a long time. We did part 1 of the stock series several months ago, and it's actually been one of our most downloaded episodes. It's been downloaded literally tens of thousands of times at this point. I should point out that you do not need to wait for part 3 and part 4. If you're just joining this conversation, JL just released his audiobook. It's now available, I believe, for download on audible.com, and you should definitely go check it out. You can hear the entire Simple Path to Wealth as explained by the author. I can't imagine a better person to read that. But if you want to have a conversation about the stock series, that's hopefully what we're going to accomplish today. And we're going to be hitting on a couple different things. We thought we'd talk about what if this is 1929. We're going to talk about portfolio ideas and really just kind of have some fun with it, pull at some threads and see where this conversation leads us. So Jim, just a big thank you for being willing to have this conversation today.
Well, let me start by saying I'm thrilled to hear that it's the most downloaded one that you've done, particularly because it puts me in such rarefied company. I have been listening to your podcast, and I am thoroughly impressed with the caliber of guests you get and the quality of interviewing that you do. And so if I'm anywhere near the top of that pack, that makes my heart soar.
Awesome. Well, we forced a mic on you this time, and we know you're going to be doing some geo arbitrage soon. So hopefully we found one small enough that you'll be willing to put it in the bag and carry it along with your very limited personal belongings on this trip.
Yeah, I think you just should send me a new one each time.
That'll be our frugal fail of the week.
Hey, but we're happy to do so too. For part 3 and 4, that's a small price to pay.
So today, what we'd like to start with is, and if I were going to tie this to one of the articles that you did, it would be part 4 of the stock series, the big ugly event, deflation, and also a bit on inflation. But to put this in context, as we're having this conversation, it's 2017, and there are a lot of people that feel that maybe the market is headed for a downturn. Now, it doesn't matter whether or not that actually happens. We're not professional prognosticators. If you want that, you can look on TV and get 50 people with 75 opinions. That's fine. We'll leave that alone. But let's say that we're looking backwards and this ends up being 1929. What happened during the Great Depression? And in the FI community, with the information that we have access to, how do we approach a situation like that?
Well, the lead up to the Great Depression, the crash of 1929, was, of course, the Roaring '20s, and it was a very robust time. There had actually been, as I recall, and I'm not a historian on this, so...
Nor did you experience it personally.
Nor did I experience it personally. I just missed it. But there had been, as I recall, a crash around 1920, something like that, and of course, the country had just come off of World War I at that point, and then you hit what we're all familiar with, the Roaring '20s. And those were boom times for a lot of reasons. And in good times, people get exuberant, and sometimes they push the envelope a little bit too far. And towards the end of the 20s, the stock market started to have a very nice rise during this period, and people got greedy. Fear and greed are what drive the market, right? And people got greedy. And at the time, it was very easy to buy stocks on margin. It is still fairly easy to buy stocks on margin, and buying stocks on margin simply means that you are borrowing money from your stockbroker to buy stocks. And the power of that, like any leverage, like the leverage when you borrow money to buy a house, is that if it goes up, you make more money. So let's take the house example just real quickly because that's what everybody is familiar with. And say you're going to buy a house for $100,000, Jonathan, and I'm going to buy a very similar house for $100,000. Maybe the two houses are next to each other. And you buy your house for all cash. You plunk down the $100,000 and you just buy that house for cash. I go out and I get a mortgage for 90% of it. So I just put down $10,000. That's leverage. That's the same thing as buying stocks on margin. Now, let's suppose that a year from now, we've bought well in the right neighborhood, and a year later, our houses have both gone up 10%. Well, you have made $10,000, which is 10% of the $100,000 you put in the game. I have made the same $10,000, but because I use leverage, I only have $10,000 in the game, so my gain is 100%. So I have magnified using leverage my gain on the same price increase we both enjoyed. That's great. And that's one of the reasons, by the way, that people are so enamored of houses, is because leverage magnifies the gains when they go up. That's also the thing that made it so terribly ugly when housing prices crashed in 2008. And that's the problem, because leverage is a double-edged sword. It cuts both ways. So let's take that same scenario. You buy your house for $100,000. I buy my house for $100,000. You put cash. I put down just $10,000, 10%. And a year later, it's gone down 10%. Well, you have taken a 10% loss on your $100,000. You got $90,000 left. I've been wiped out. I've taken 100% loss. So now let's go to the stock market and back to the 1920s. People are buying stocks on margin, and they're bidding up the price of those stocks to irrational levels because everybody is making money hand over fist, because when you buy on margin, that puts more and more money into the game and it extends things more and more. And as always happens, eventually the music stops and everybody's scrambling for a chair. And when the music stops and the market starts dropping, if you are not buying on margin, just like with your house, the most you can lose is 100% if it goes completely to zero, which the market's never done. But if you've margined yourself by, say, 50%, which is common on stock margins, if the market drops 50%, which of course it did not just in the Great Depression, but just a decade ago in 2007, 2008, you're wiped out. And if your broker is calling you for margin calls, which means that the stock is going down and they want to make sure it doesn't go down so far that they're holding the bag for what you owe, you are forced to sell. And that creates an even greater selling pressure on the market than the natural ebb and flow would ordinarily have. And so when you have a lot of margin built into the market and the market starts to drop, and markets are very volatile, they're always going up and down, so there's always times they're going to drop. Well, if you add margin into that, suddenly that drop gets accelerated and it gets faster and faster and deeper and deeper. And in 1929, you had the stock market crash.
And I want to pause on that for a second, because it's that margin call that makes the comparison so much more dangerous for doing this with stocks as opposed to getting a mortgage on your home, because you don't see that many people worried about using leverage to purchase their primary residence.
Right.
The fundamental difference there is that if your house does go down in value 40%, the mortgage company is not coming to you and asking you to cough up the balance, as long as you can afford to make the payments. That's the difference. And I guess if you were to go back to 2008, the problem was because of the massive scale and the horrific lending practices, they were not ensuring that the people that were getting these homes could make the payments. And ultimately, not to go down that rabbit hole, but that's why the whole system crashed in 2008.
So Jim, in this article, part 4 of the stock series, you have 4 lessons here. And the first one, which we've talked about, is never buy stocks on margin. The second, if you don't mind me reading, because I love the writing here. If a time comes when you're reading and hearing about people routinely making fortunes in an aggressively rising market using margin, something very, very bad is around the corner. And you say Joseph Kennedy is said to have known it was time to exit the market in early 1929 when he started getting stock tips from shoeshine boys. And I just love that.
Yeah, that's as far as I know, is a true story.
And I want you to comment on lesson 4, but let me just quickly read lesson 3. If you see lesson number 2 forming, it is a good time to take your chips off the table, which is very tough to do when everybody is making quote unquote easy money. And lesson 4, once the crash comes, it is too late.
Well, let me first comment on lessons 2 and 3, because they are kind of linked together. I am somewhat famous for saying that the market is volatile and we can't predict when it's going to plunge, and therefore, we ignore the volatility. We're buying for the long term. And if anything, we make the volatility work in our favor when either we are building our wealth and adding money to the market weekly or monthly, or as our earned income comes in and we're saving a portion of that and we're adding it in. And so when the market dips, we get to buy at those lower prices, and that smooths the ride. Or once we're living on our portfolio, bonds play that role, and we adjust the allocation, which takes advantage of those market dips. So in lesson 2 and lesson 3, though, you hear me saying something that begins to sound a lot like market timing, which I mostly preach against. So those two are things that are really out on the far edges of the market. When things really get out of whack is the only time that I would say begin to take your chips off the table. And of course, whenever you have a long bull run like we have now, people start to get antsy and say, is now the time to take the chips off? Is now the time? And those times are very, very rare and probably unpredictable. And then lesson 4 is that once the crash comes, then it's too late. So typically investor behavior is the market goes up for a number of years and it begins to feel normal and the money feels easy and they start investing, and then all of a sudden it crashes, or maybe it doesn't even crash. Maybe it has a correction, which is a 10% decline, or a bear market, which is a 20% decline. Crashes are like 30+%. And then people get all nervous, and after the decline, they sell. Well, that's the classic closing the barn door after the horses have run away.
That is the most painful thing. And I think what it comes back to for our community is latching onto this idea of the beer and the foam. And especially when we're following your general advice and we're following the more or less the advice of the FI community, and we're latching onto index funds. We own a very small piece of the United States economy. And what you're asking yourself is, do I think that at some point in the 5 or 10 year future, or whatever it may be, it's going to come back? And if you sell at the bottom because you say, I don't want to lose any more, you're contributing to a fire sale that you can never recover from. And I think having the confidence and just stepping it away and saying, what does this volatility represent? What does this crash represent? Is there a actual change, or do I still own, at the end of the day, a piece of the U.S. economy? You got to be able to make peace with that in your mind, and then hopefully make a decision based on that.
I agree, Jonathan. I think you're absolutely right, because the fundamental investing choice you're making, first of all, we should say that there are index funds these days. There's a huge range of index funds, and there are index funds for very small sectors of the market, and that's not what we're talking about. We're talking about broad-based index funds that track the S&P 500, or my personal preference, that track the entire stock market, a total stock market index fund like VTSAX. So if you buy something like VTSAX, total stock market index fund, or even an S&P 500 fund, you are basically betting on the economy of the United States. And to do that, you have to believe that the United States is going to, for the foreseeable future, remain a dynamic, successful economy. It's always going to be volatile. It's the nature of economies. But unless you believe that the United States is in a permanent long-term decline, or it's about to collapse as an economy, I'm famous for posting this series where I say the market always goes up. Well, as long as the U.S. economy is remaining strong and robust overall and has a future, that will always be true. If the United States goes into a tailspin that's non-recoverable, then eventually that, and someday it will, by the way, nothing lasts forever, then obviously the VTSAX and the U.S. stock market, by extension, won't be going up at that point. But I don't see that happening in the near future. I think the United States is good for at least another 100 years as a dynamic, volatile economy. It's not going to be the same as the last 100 years. It's not going to be the same as it was today, but I don't think we're going away anytime soon. And if you believe that, then the way I recommend you invest makes sense. If you don't believe that, and not everybody does, if you believe the U.S. is on the verge of collapse, then obviously you don't want to be investing in the stock market of the U.S. Just like if you believed in any country, if you you thought it was on the verge of collapse, you wouldn't be investing in the stock market.
I think that definitely simplifies it from all the other variables that maybe you have to look at if you're an active investor. It simplifies it down into a much more easy to comprehend, almost binary choice, which then will allow you to dictate the decisions you make. So I get that. That makes sense to me. I think it would be interesting, just for the sake of conversation, to dial it back and talk just for a second about that person to be that investor in 1929.
That's a great question. So let's start out by saying that there's no way around it. The stock market crash of 1929 and the ensuing Great Depression was, as I say in the title of that post, a big, ugly event. I mean, there's just no way around that. Stocks went down from their peak to their bottom, something on the order of 90%. So if you had $1 million in the stock market in 1929 before the crash, by the time it hit its bottom, assuming that you didn't sell, you'd be $100,000. So there's no question that's ugly. And it did eventually recover, but, it took a fair amount of time to recover. With that in mind, it pays to step back and say, well, okay, are there any mitigating factors? Well, if you'd stayed the course, you would have eventually recovered. That's number one. It would have taken a while. If you had been one of the 75% who kept their jobs, so the unemployment rate during the Great Depression reached 25%. The implication of that, of course, is as bad as that is, 75% of the people were still working. If you were one of the fortunate 75%, and the odds, of course, were in your favor, and you kept investing in that stock market, if you kept the faith, you would have been buying stocks at extremely advantageous prices.
So I guess the takeaway point there is, may the odds forever be in your favor. It's almost like a tagline for a movie. I wish I...
Yeah, the point is, I've said that if you were a young investor, just starting out, or just even a few years in, the very best thing that could happen to you is a stock market crash, assuming that it doesn't scare you away, and assuming that you keep working and you keep investing because you are buying stocks at lower prices. You're buying them on sale at bargain rates. So anybody who's listening to this, who's young and just starting, you should be rooting for the market to take a plunge. I get on the blog periodically, I get a lot of comments from investors of all stages, but I have a fair number of young beginning investors, and a typical comment that concerns them is they'll say, I've put together $10,000 or $20,000 and, it's sitting in my bank account. I want to put it in the market, but I'm just afraid. I'm just afraid that if I put it in the market today, that it's going to drop dramatically tomorrow and I'll lose my money. And that's an understandable fear. But if you take the longer horizon and you're working towards financial independence, that $10,000 or $20,000 is not a lot of money. You're going to look back on it in a couple of decades and it's going to be pocket change to you. So as hard as it is to believe, if you put that $10,000, which probably took a lot of blood, sweat, and tears for you to pull together, you put it in the market, and tomorrow the market chooses to plunge 50% and you get cut in half, celebrate, because you are going to continue to invest in the market and you're going to be buying at better and better prices. So in a sense, that's why volatility doesn't concern me. As long as you don't panic and sell, it's going to recover. If you're continuing to put money in, it's going to work to your advantage. If you are at the stage of your life where you no longer are earning money and so you don't have cash flow to continue investing, at that point, if you're following my advice, you diversified into bonds. And so when the market plunges, you will be selling some of your bonds to buy those stocks at that lower price. And by the same corollary, when the market recovers and goes up, you'll be selling some of that to go back into bonds to maintain whatever asset allocation you have chosen. Does that make some sense?
Yeah. So my big takeaways are the psychology of it, which is don't get freaked out, even if you do see your money in your hypothetical go from 10K down to all the way down to 5,000. And really the bedrock foundational principle of the FI community is live below your means, right? And have a savings rate. Hopefully it's 30, 50, 70%, something like that. And you're continually pumping money into your stock investments. And to your point, you're buying it at a huge discount. So that's why you're saying you should celebrate if that happens to you, if that timing is exactly right. Now, obviously, in a perfect world, this person isn't losing the $5,000, but you're saying that's completely immaterial over the long run. And you're then getting to buy at discount prices potentially for years.
Brad, you're you're absolutely right. You hit the nail on the head. In fact, I might even go so far as to say, let's suppose I had a magic wand and I could make things work, and somebody in their 20s comes to me and I want them to be as successful as possible, and they have $10,000 and they put the $10,000 in the market. I'm going to use my magic wand and immediately have it go down 90%, go down to $1,000, just because the power of that savings rate that you talked about and the new money coming in will so vastly eclipse the $9,000 they lost. They will be better off by taking that hit early. That's why I can't emphasize enough that unless you think the United States of America is swirling down the drain, I can't emphasize enough how important it is not only to stay the course and not panic and sell, but to take advantage of the drops and keep adding money as you go along. And by the same token, you don't want to stop adding money when the market goes up, because the market can go up for long periods of time to heights that at the beginning you wouldn't have thought were possible. And you don't want to lose that. Just keep putting the money in, keep putting it in. And truly, I tell my daughter, don't pay any attention to it. The ideal thing is put money in. The savings rate is key. Put as much money in as you can, whenever you can, and otherwise ignore it. Jack Bogle says something similar, and he says, and then in a few decades, when you decide to finally look at your statement, he says, don't even look at your statements for decades. And then in a couple of 3 decades, when you finally decide to look at your statement, see where you are, make sure you have a cardiologist next to you.
Right.
Because you're going to have a heart attack at how well you've done.
And the reflexive thing that I want to point out here is that nobody in this room wants a recession to happen. There's a lot of pain and heartache that comes when the market crashes, and that's recognized. But when you're talking about your mental game, when you're talking about how in the FI community, how to handle that and how to handle the own personal fear that you have about whether or not you should put money in and what to do if it crashes, for you to recognize that if it does crash, if the market does go down, there is a play for you there. And by being empowered with this information, you will financially benefit from this in a very big way. That's going to be big for you. So if you're armed with information, you are going to do very well.
Well, I would also say, Jonathan, that whether we want a recession or we don't want a recession, whether we want a market crash or don't want a market crash, Mr. Market doesn't care even one little tiny whit. The market is and the economy are going to do what markets and economies do regardless of what we want. So that's part of adjusting the psychology. That's part of in one of my earlier posts in the stock series where I say, toughen up, cupcake, because recessions are never going to go away. We're always going to have recessions, whether we like them or we don't like them. It just doesn't matter. They're a fact of economic life in our economic system. The market is always going to be volatile. It's always going to have bull runs like we're having at the moment, and it's always going to have bear markets like we will at some point. I have no idea when. Let me say I'm not predicting a bear market tomorrow or the next week, but it could happen. And I will say absolutely that we will see bear markets again. But yeah, the markets don't care what we want or what we don't want. And so we have to toughen up and just accept that this is the way it is. Once you understand that's the way it is, then you can begin to think about, okay, how do I deal with this reality? How do I deal with it when it goes up? And how do I deal with it when it goes down?
I'm adopting that tagline, toughen up, buttercup. That's definitely a tagline.
Cupcake. Toughen up, cupcake. You can change it to buttercup if you want, but on my blog, it's toughen up, cupcake.
Perfect. You made this great comment on the article, and you said, none of this is to say that big, ugly events are not very scary and destructive things, but they are rare. And in the context of our overriding approach, spend less than you earn, invest the surplus, and avoid debt, they are survivable. That ties in so perfectly with what I would say is the overall theme of your article series, and it's that simple is good, simple is easier, and simple is more profitable.
And it's more powerful, absolutely. And it does tie in with that theme. And it's not to say that we will never see another Great Depression again. We have seen stock market crashes. I mean, I imagine most of the people listening to this lived through the crash in 07, 08, 09. I mean, that was the second ugliest in our country's history. So it's not like these things are never going to happen again, but they are exceedingly rare events. There's a book, I forget the author's name, but the guy who wrote the book about black swans.
Oh, Nassim Nicholas Taleb.
Yeah. So he wrote this book, The Black Swan, which is a great book. I highly recommend it. And just real quickly, a black swan is a very rare but very traumatic event that happens, and it could be in the economy, like a depression, the crash of '29. It can be war. It can be any number of different kinds of traumatic, earth-shaking things. But by definition, it's important to remember that they are very rare. So if we look at it in terms of the stock market and the economy, black swans like the Great Depression, the crash of '29, even the one in 08, 09, are very rare events. And so as an investor, you have to ask yourself, okay, I know black swans exist. I know they can happen. What should I do about that? And the problem is that if you fall prey to fear of a potential black swan and you start adjusting your investment strategies expecting one or against the time it might come, you are going to leave a lot of money on the table because they are so rare. Most often, they don't happen. So let me illustrate this. Let's suppose that the three of us are sitting around in 1975. And I picked 1975 because in my book, I talk about the stock market period from 1975 to 2015, which is when I was finishing the manuscript and writing this, and that's a nice 40-year period. I chose 1975 because that happens to be the year I personally began investing. It happens to be the year that Jack Bogle created the first index fund, and it happens to be a nice 4-decade chunk of time. So let's suppose that the three of us and maybe our audience, we're all sitting around having a cup of coffee, and it's 1975. And I say, guys, I got some news. I have a time machine. And I just came back from 2015, and I looked back at the next 40 years that are coming from 1975 here where we're sitting. And let me just tell you what's going to happen, because I've seen it. I've come back from the future. So here's what's going to happen. You know, we're in 1975 and inflation is ramping up and it's kind of ugly. That's going to get a lot worse. I mean, by 1980, by the early 80s, we're going to see mortgage rates at over 15%. And there's going to be this thing called stag inflation, because not only are we going to have this outrageous inflation, but it's going to be tied to a stagnant economy. And it's going to be so bad that in the late 70s, Business Week, this highly regarded magazine that everybody thinks is on top of things, they're going to run a cover story called The Death of Equities. That's how bad it's going to be for stocks. And then in 1982, we had the beginning of a bull market. And that was really nice. There was this bull market, and it went all the way up to 1987. And then in the fall of 1987, we had Black Monday. And Black Monday, the market dropped the biggest percentage in history. I mean, right up until 2015, it had never dropped that far in one day. It dropped 25% in one day. It never happened in history before. And that triggered this nasty recession that lasted into the early 90s. But then there was all this cool technology. I won't tell you about it because you wouldn't begin to believe me sitting here in 1975, some of the cool technology that's coming. But there was this cool technology, and there were companies around that, and they started going public, and there was this big tech boom, and people started making money again, and it really looked great. And then, you know, around the year 2000, that all collapsed. Actually, in 1999, that all collapsed, and we had what was called the tech crash. And then shortly thereafter, there was the biggest attack on U.S. soil since Pearl Harbor. We got attacked by foreign actors on our own soil, the biggest attack since Pearl Harbor. And that dragged us into two wars that were very much like Vietnam, that lasted for years. In fact, when I left in 2015, they were both still going on. And we were really making no progress, just like in Vietnam, and that dragged us down. But anyway, in spite of that, the good news is that after 9/11 and the tech crash and everything, things started to get better and better again. We had this another little bull run, and then these lenders started lending out money without any consideration to people's ability to pay it back to buy houses, and the housing market exploded. Housing prices were going up. It became this great bubble, and it burst and it collapsed. And that created the greatest economic depression or drop since the Great Depression. The only one we've ever had in the history of the country was the Great Depression back in 1929, in the 30s. That's how bad that was, and that lasted for 2 years. And then the good news is, beginning in 2009, that seemed to have bottomed out. And as I got in my time machine to come back here to 1975, in 2015, the market had recovered kind of nicely. It was back on one of those bull things. So that's what the next 40 years holds, fellas. Now, the other thing that's just happened here in 1975 is this guy Jack Bogle just created this index fund where we can invest in the stock market in the U.S. Who wants to put all their money in the stock market now?
Pick me.
Yeah, well, you would have been rare, because most people would have looked at that litany of disasters and would have said, "No bloody way, Jim."
Right.
The last thing in the world I want to do is be in the stock. If you're right that that's what our future holds, all that angst and disaster and war and collapses, the stock market's the last place I want to be. Are you out of your mind? I don't know who this guy Jack Bogle is. I don't know what an index fund is, but I do know I don't want anything to do with stocks. Well, of course, the rest of the story is that over that 40-year period, stocks returned just under 12% a year.
11.57, right?
11, I think it was 11.9 actually, but I'll take 11.7. I'll trust your memory over mine.
That's amazing.
Yeah. So the point is, the market, there's a saying on Wall Street, the market climbs a wall of worry. The market in the last 40 years has been incredibly volatile. It's had more than one crash, and yet it still has returned just shy of 12% a year. It's a little bit stunning. Now, I have no idea what the next 40 years are going to be like, and I'm not suggesting that the next 40 years are going to return 12%. I make this point in my book, and I've gotten some criticism because I use the figure from the last 40 years because that's what actually happened in that period of time. You can take any period of time, by the way, and get different numbers. If you took the period of time from 1982 even to 2000, the market increased much more. I think it was like 18% a year on average. By the same token, if you took the period of time from 2000 to 2009, it was nowhere near 12%. So a lot of this depends on what particular period of time you take. You'll get different numbers. But in 1975, which was the year I started investing, to 2015, that 40-year period was filled with all kinds of challenges and problems, and it still posted incredible returns.
Yeah, Jim, that's remarkable. A 12% annual return compounded over 40 years. Just using the rule of 72, that means right. Your money would double every 6 years approximately, slightly more since we're saying it's slightly under 12%. But that's amazing. Your money would double 6.67 times in that 40-year period. And that's even counting all those absurd catastrophes that you listed. Like you said, you would probably run for the hills if you came back in that time machine and told us all that. But it would have been the best thing you could have ever done to invest in that money.
Right. And this is, by the way, nobody knows what the next 40 years will hold. I would imagine the next 40 years will be equally traumatic because we live in traumatic times, but we also have a very dynamic economy, and there is a lot of things happening in the world of technology and advancements and breakthroughs on the scientific front that, I don't know what the market's going to do the next 40 years, and nobody else does either. Who knows? It could be an unmitigated disaster, and we could have the zombie plague, and civilization collapses. But it could make the next 40 years look like it was standing still. We just don't know. But the point is that it's incredibly powerful, even through some really, really challenging times. And I imagine my guess is the next 40 years will be every bit as challenging and every bit as rewarding.
So our community has basically more or less agreed on at least using index funds for the basis or the brunt of our investment vehicle. Certainly it's what Brad and I preach in large part due to your article series. And One of the things that now that we've boiled it down or distilled it down to its most simple level, what we would like to do next is maybe talk about the different tools that you have in your bag and talking a little bit about the different things that you should be considering.
Let's go for it.
In your article here, you post three considerations. And the first one is, what stage of investing life are you?
Let me start by saying that the classic way of looking at what stage of investment life you are is based on your age. And that in old days, or even today, for most people, that kind of makes sense because most people lead fairly traditional lives. And that means that they go to school, they come out, they either go to college or they don't go to college, they get a degree, they don't get a degree, they go to work, and they work for 40 years. And hopefully in that 40 years, they accumulate some assets and then they retire. And that sort of defines your stage of investing. And you accumulate your wealth over that 40 years, and then hopefully you've done well and you retire on it. In the FI community, of course, we're striving to reach financial independence much faster. Our savings rates are much larger. People typically hit FI or they get close to it. Maybe they change careers or maybe they stop working for a while and they travel and then they find something interesting to do and income starts coming back in. So your stage in life for the people listening to this in the FI community isn't just defined by your age. It's defined on what you happen to be doing. There'll be periods of time where you're working, you get to FI, or maybe even mostly to FI, and then you're doing other things, traveling or whatever, that aren't bringing in income, and so you're living off your investments, and then maybe suddenly you're doing something that brings in income again, and it's going to go back and forth. So how you are invested or how you want to be invested is going to shift based on what stage you're in. And
so you've essentially painted a different picture. And instead of us just talking about what you need to be doing when you're 65 and what you need to be doing when you're 35, it instead comes to your mental game, to where you are. At this point in your life, are you trying to build your wealth or are you trying to preserve it? Am I on the right track here?
Yeah, absolutely. And the point that I would make is that you can go in and out of those stages. So you might, presumably at the beginning of your career, you're definitely going to be in the wealth building stage. You're going to be working. And if you're pursuing FI, you're going to be saving a very large amount of your income, upwards of 50% ideally. And that's your wealth building stage. And then you're going to get to the point where your investments can begin to support you and you might stop working. And that becomes your wealth preservation stage. And when you stop working, maybe you're traveling around or doing whatever it is that you want to do that is not paid work. Maybe you stumble upon something that begins to generate income again. So you go back into the wealth building stage. So you might, because we're talking about people who are going to be hitting financial independence fairly early, you could go into your wealth building stage, to your wealth preservation stage, and back again a couple of times in your life.
Yeah, and this goes back to something that I was calling the rotating swivel door. So if you want, feel free to use that in your articles. I give you permission.
Thank you. I'll have to know how much you're going to charge me for the privilege.
Exactly what you're charging me. I want it all back.
There you go.
Hey, Jim, talk us through what you would advise people in these different stages as far as like the percentage that they would put in equities, bonds, et cetera. Talk us through as they're going through this swivel door, whatever it may be, or hopefully it's a one way. But what do you generally advise on the blog and with people that you speak with?
So great question, Brad. So in the wealth building stage, I'm fairly aggressive, and I recommend that people be 100% in stocks, and very specifically, if possible, in VTSAX, which is the total stock market index fund done by Vanguard. Now, I say if possible because when people are working, they're frequently funding 401k plans or 403b plans, and they're restricted to what investments those plans offer. But basically, you want a broad-based stock index fund, or maybe a couple of them if you have one in your 401k or another in your personal investments. But you want to be 100% in stocks because your savings rate is high, and that constant flow of new money coming in from your 50%, let's say ideally a 50% savings rate, that tends to smooth the ride. So that's when the stock market plunges, as it does periodically and expectedly, you can celebrate that because that money you're putting in is buying more shares of your VTSAX. And so you just keep putting money in. You don't care what the market's doing. You're just putting in as much money as you can whenever you can. That's the wealth building stage. And because stocks are the most powerful wealth building tool available to us, we want to be 100% in stocks. That means, of course, we have to be willing to accept the volatility. The best way to accept it is to just ignore it. Don't worry about it. If anything, celebrate when the market drops, because each dollar you put in then buys some more shares than it would have otherwise.
And I want to pause and highlight that, because that's the critical part. When you're in this and you've identified yourself as being in the wealth building stage. So mentally you say, I am in the wealth building stage. I want to accumulate wealth. That is, you have to have your psyche right for this. So anytime the stock market goes down, you don't care, except that now you almost want to get more in there. And anytime you see the stock market go down, you don't say, oh man, son of a gun, this is hurting my returns. No, you're saying it's a fire sale. It's on sale. I'm purchasing more of the U.S. economy for the same price as I was last week.
That's exactly right. It is a different psychology than the psychology of the vast majority of investors. I continually get comments on my blog from people who are young and new to investing, and they've saved up, say, $10,000, which is a lot of money to them, and I appreciate that. And they're about to put it in the market, and this money didn't come easily. They worked hard for this money. And the idea that they could put it in the stock market and see some of it disappear, maybe even get cut in half or worse, that's terrifying. But if you're using the approach that we're talking about, you should turn that psychology on its head and celebrate those drops, because it means that you're getting to buy things on sale. I have frequently said, if you could make the market do anything you wanted it to do, what you would want it to do with your magic wand is the moment you started investing, you would want to see a major stock market crash. And then you would want to see the market just bump along that bottom for the next 40 years while you invested, and then you'd want to see it skyrocket. Now, of course, it's not going to do that. But the point is that if you're investing, if you're working and you're saving your money at a 50+% savings rate and you're investing, dips in the stock market allow you to buy things on sale. They are your friend. The volatility shouldn't bother you. Now, by the same token, some people say, well, gee, that means I shouldn't buy when the market's going up. And unfortunately, that doesn't work, because right now, for instance, the market is very near its all-time highs, and that has a lot of people nervous, and they say, well, maybe I shouldn't invest now, especially if they're doing what we're talking about, where they're working and they're saving and investing 50+% of their money. Say, maybe I should stop. Well, the problem is nobody knows what the future holds. Tomorrow, the market might plunge 50%, or today might be the lowest we will ever see the market in our lifetimes. We don't know that. So you never know exactly where the market is, which is why you have to keep investing all the time. Because while it's great when the market drops, and psychologically you need to say to yourself, gee, I get to buy some stocks cheaper than I did the day before, there's no guarantee that you're going to get that drop from this point. And you can't time it, is what I'm trying to say.
Yeah, that makes perfect sense, Jim. And so you're saying 100% equities in the wealth building stage, and then what about wealth preservation?
So the wealth building stage, just real quickly, is when you are working and you have an income flowing in and you are saving a percentage of that, hopefully 50+%, and you're building your wealth. So that's 100% stocks. Now, at some point, the whole reason that we want to do this is that we can be independent of paid work and jobs. Doesn't mean we're never going to work again, because work is satisfying and worth doing, and we may even work for money again, but we no longer have to work for money. So that becomes the wealth preservation stage. So when you stop working for money, whether you stop working for money at age 30 and you wind up working for money again at age 35, or you stop working for money at age 65 and you never work for money again, whenever you stop working for money, trading your labor for money, you've entered the wealth preservation stage. So when you're in the wealth building stage, that constant flow of your earned income that you're diverting to your investments is what smooths the ride, because you're investing all the time, and that tends to even out the peaks and valleys. So that is that ongoing flow of money is smoothing the ride. When you don't have that ongoing flow of money because you're no longer earning money, you need a different strategy, and that's the wealth preservation stage. And what you do to bring balance into your portfolio, now that you don't have your own earned income to do it, is you start allocating some of your portfolio to bonds, because bonds tend to be more stable than stocks. They tend to stay stable when stocks are dropping, and they help balance the ride for you. And so you will pick a stock allocation, or you'll pick an allocation rather, between stock and bonds, and then you will adjust that allocation maybe once a year. You don't have to do this very often to keep it in balance. And that has the effect of when stocks are down and bonds are up, your percentage of bonds will have gone up, and you will be buying more stocks at the low price to bring them back into balance with where your bonds are. By the same token, if stocks continue to go up, the percentage of bonds will continue to go down, and you'll want to start selling some stocks and adding bonds to bring them back into balance. And that's how you preserve your wealth. Now, the question that, of course, everybody is probably asking themselves is, well, what percentage do I keep in stocks? And what percentage do I keep in bonds?
Jim, you're stealing my questions from me.
I'm sorry. Well, I'll back off and let you ask that question.
Thank you. Just pause right there.
I'll pause right there.
Jim, what percentage should I have in stocks? And what percentage should I have in bonds? See, now you can have it back.
Well, that's a wonderful question. I wish I'd thought of that myself. Man, you are one astute interviewer. I gotta hand it to you.
We could just take a nap here. Actually, you're so good at this.
So my understanding of this is that we have a couple different tools in our bag when we're talking about these allocation models. And essentially, just for you to be able to draw this out of your tool bag, we have stocks, we have bonds, and then we have cash. And those are the three different things that work really well together when you're coming up with a model, and you're essentially basing it on your risk, your investment horizon, all of these different factors. They will determine the ratio of those three things, right?
Exactly. So when you're in the wealth preservation stage, you are going to be owning primarily a stock fund and a bond fund. A total stock market fund, a total bond market fund is ideal. You are going to have some cash because you have ongoing expenses and operational needs, and you don't want to have to be forced to sell things at an inopportune time. But the question then becomes, well, how much in stocks and how much in bonds? And that really speaks to your personal risk tolerance. So the more you have in bonds, the smoother your ride will be. But the lower over time your returns will be, because the return on bonds is very low compared to stocks. If you can graph VTSAX, which is the total stock market fund, against the total bond market fund over a 10, 20-year period of time, you will see a very volatile line for the stock fund, but that winds up much higher at the end of the period. A much smoother line that doesn't rise very far. So when you buy bonds, you are trading volatility. You are sparing yourself volatility at the expense of long-term returns. So you have to ask yourself, how much am I willing to give up to have to smooth my ride, to reduce the volatility? When stocks plunge, bonds tend to hold up, and then you're going to be glad that you have bonds. Even if you're very aggressive, you can tolerate the swings of stocks, you might want to have bonds just so you have this rebalancing tool we were talking about that you can bring to bear. Personally, I do, because I'm in the wealth preservation stage, I do 75% in stocks, 25% in bonds. That's considered pretty aggressive, and I want to be on the fairly aggressive side. So if you went more than 75% stocks, you would be choosing to become still more aggressive. And if that suits your own tolerance for volatility, that's fine. There are some people that I respect who even say I can tolerate, even in the wealth preservation stage, I can tolerate 100% stocks because I have enough money and I have enough tolerance for volatility. By the same token, if the volatility prevents you from sleeping at night, then 75% stocks is probably too high for you. And you have to make a choice not just based on the numbers, because the numbers would suggest you want to be always 100% in stocks because over time they outperform everything else. But you also have to have to think in terms of your comfort level. And again, I like some bonds just because I like to take advantage of, I like to have something else when I don't have that inflow from earned income to take advantage of the stock market volatility. I like to have the rebalancing between stocks and bonds to do it for me.
And Jim, that's kind of what I was going to ask next, which was, let's just say for argument's sake, you personally live a FI lifestyle, your expenses aren't significant. Let's say you make some money from your website. You obviously have book sales and hopefully audiobook sales. At some point, you're going to get Social Security and et cetera, et cetera. Has there ever been a thought that you would move back to 100% equities? Is that something that's ever crossed your mind, or are you pretty comfortable with 75 now?
Brad, that's a great question and a very pertinent one to me personally for all the reasons that you just outlined. So my working career I didn't retire early because during my career, that just wasn't a concept I even had in my head. I did step away from my jobs for various lengths of time, anywhere from 3 months to 5 years, but I always did it with the intention that I was going to go back to work at some point. I never thought of it as retirement. The last job that I quit that I figured I wasn't going to work again was back in 2011. Very coincidentally, that's the same time I happened to start my blog, and the two are not at all related, surprisingly. So at that point, in 2011, I went to this 75-25% stock bond mix that I was just talking about. More recently, and I never intended to make money from the blog, but the blog has grown in ways that I never anticipated. And effective actually last year, it started making money a couple of years ago, but it was really just sort of breaking even with its expenses. So I wasn't showing any great income from it. But last year, the expenses have stayed fairly stable and the income has grown rather nicely. So suddenly, as of 2016, I had income from the blog. And then also in 2016 is when I published my book, The Simple Path to Wealth. And that's been much more successful than I could have hoped. So I have income coming in from that. So suddenly I have money coming in again in a way that I never anticipated. So I'm still sitting on this asset allocation and I am debating what I want to do if I want to move back towards 100% stocks. My hesitation is that the book has been selling very well. It's been out for a little over a year, but I have to assume at some point it will saturate the market and those sales will begin to drop down. I just put out the audio version of the book and that's doing very well. And so far, it has not pirated sales from the Kindle or the print version. But I can't sit here and comfortably say, well, it'll be the same next year or 5 years or 10 years from now. The same thing with the blog. The blog is humming along nicely, but I don't know how much longer I want to keep working on it. And I may stop putting up new posts and then it'll still have a momentum of its own. So anyway, a long way of saying, I do have current income coming in that I never anticipated. I just don't know how long it's going to last. And so I am debating with myself whether to move to 100% stocks or not. And I haven't pulled the trigger and I haven't made the decision on that.
So would there ever be a case for someone to do... I'm just trying to put myself in the situation of someone coming to you asking for an allocation that would suit their particular lifestyle and what the criteria would be for you to say a 60-40 or a 50-50 or similar to what you're doing, a 75-25. I'm just trying, what would be the different factors that would be crossing your radar before you would, that would be the scenario that you would lay out?
Well, that's a great question, Jonathan. And I think there are two factors to it, right? There's the mathematical factor, let's call it, and there is the emotional factor. You are always better off being in stocks because stocks over time outperform everything else. If we go back to the conversation we had about the last 40 years and that litany of disasters that I was able to put out in front of you, and yet in spite of all that, the stocks returned almost 12% a year. So stocks are a very powerful wealth building tool. So just looking at the numbers, you can make an argument that you should always be in stocks. My friend Jeremy, who writes Go Curry Cracker, he's a big believer in being 100% in stocks for exactly that reason. And he has a very high tolerance for the volatility. The only downside of being all in stocks is that incredible volatility. And again, we're assuming that the U.S. as a country and an economy is going to continue to do well over the next 100 years. If you don't buy that, then everything I said doesn't make any sense. But there's the emotional side of it. And most people want something that smooths that volatility because the volatility can be very ugly. Now, in the last decade, since, well, not quite a decade, but the last 7-8 years, the market's pretty much done nothing but go up. And that tends to make people complacent, and especially new investors. And it's hard to overemphasize how ugly it is when you have a 1987 and in one day the market suddenly goes down 25%, or you have a 2008, 2009 where the market gets cut by more than 50%, and it just never seems like you're going to get to the bottom. So don't underestimate how difficult that is to deal with emotionally, and how hard it is if you're 100% in stocks to stay the course through that. It's easy to do it when the market's going up. It's most profitable to do it when the market's going down, but it's also very, very difficult to do it. So that's when you enter in, when you add bonds, because it smooths that ride when stocks take their next inevitable plunge.
So someone comes to you and they know that you have spent a lot of time researching this topic and they're very comfortable talking about it. And they say, my parent I'm trying to help them with their finances, and they have $400,000 that are in an investment vehicle that they've told me, they'd like for me to help them put it somewhere. They don't have any additional income coming in. They're not in the FI community. They don't have the flexibility, and we want to give them advice, but we don't want to put them in an overly risky scenario. What are the questions that come to your mind when someone presents you with that scenario?
Well, the first question that would come to my mind is, how comfortable are they with volatility? So there are a lot of people who are very uncomfortable with the stock market and very uncomfortable with the volatility of the stock market, and that volatility is never going to go away. So the first thing I would say is, if your parents are fearful about the stock market, if volatility makes them uncomfortable, and if there is any chance at all that when the market plunges, as inevitably it will at some point, that they're going to panic and sell at the bottom, then keep them out of the stock market. I mean, the stock market has wonderful long potential to build wealth, but you have to have a long-term horizon. And if you don't stay the course, everything I've said doesn't matter. If the market goes down and you or your parents panic and sell, then nothing I've said works anymore. It's all predicated on the fact that you're going to ignore the volatility. If anything, you're going to add to it, either by selling some of your bonds or by your oncoming cash flow. So I guess the first question becomes, as the philosopher once said, know thyself. And unless you are absolutely sure, or your parents, if you're advising them, are absolutely sure that they can tolerate the volatility and will stay the course, then you don't want to be around stocks. Now, as to what your allocation ought to be, if you say, well, my parents are, they're not, stocks make them nervous. I think they'll stay the course, but boy, they're sure not 100%. They're not Go Curry Cracker. They're not Jeremy.
There's not very many Go Curry Crackers out there.
Exactly. That's true. There are not very many Go Curry Crackers. And one of the things that I'm afraid of, by the way, is I hear on my blog from commenters more and more people, young people especially, sort of cavalierly saying, yeah, I'm going to be 100% stocks and I don't care if the market drops. Well, unless you've lived through a market drop, don't be so sure. It's breathtakingly scary. I mean, it's breathtakingly scary. In 1987, when the market plunged, I panicked and sold. I sold at the bottom. Now, that was an expensive lesson as I watched it march back up, and I bought in after it had passed my high point before it had crashed. When the market plunged in 08 and 09, I didn't sell. And part of the reason I didn't sell is because I had that 1987 experience under my belt. But I was still nervous. I mean, it is breathtakingly ugly when the market plunges the way it can plunge. And so nobody listening to this, unless they've lived through it, you got to look long and hard in the mirror, and you can't assume without a lot of soul searching that you're not going to panic. And when it happens, you just have to remind yourself that it will. And if it doesn't recover, then nothing matters anyway. It won't matter what you do. So you have to just stay the course, but I can't emphasize enough that it's easy to say in the middle of a bull market like we're enjoying now. Very hard to execute when you see your nest egg go from $1 million to $500,000.
But it almost sounds like you're saying that bonds, at least for you, are really merely a crutch to keep you from selling at the bottom.
Bonds smooth the ride. Bonds, the function that bonds have, especially in this day and age where interest rates are so low. And, in the old days when bonds paid higher interest rates, they were much more attractive investments to have in a portfolio anyway. So if you had a bond that was paying 7 or 8%, and you had stocks that maybe had, with more volatility, a historic return of 10, 12%, well, bonds suddenly became much more attractive. Interest rates are so low now that bonds really, in my mind, are just ballast to keep you balanced and to smooth the ride. And so how much you hold in bonds depends on how comfortable you are with volatility.
So for that 60-year-old or 70-year-old example that we were just talking about, even if they are 100% go curry cracker, they're hardcore. They've bought into it hook, line, and sinker, but they're not earning income. You could make the case that they should still be considering this, 25% or 50% or 40%, whatever that number is, just because they keep the volatility is more dangerous for them, especially if they have to have that income and they don't have the flexibility that maybe we talk about building into your life when you've grabbed this concept at a younger age.
Well, you covered a couple of different things there. So let's take the last one first, the flexibility. So if you have a situation, let's say you have $1 million, and using the 4% rule, which is a rule of thumb as to how much you can safely withdraw from a portfolio, that throws off $40,000 a year. If you need every penny of that $40,000 to pay your bills, then you are in a much more precarious position than somebody who has $1.5 million and can pull $60,000, but their core spending is really at $40,000, and the other $20,000 is when they do travel or whatever additional things they do. So it does depend a little bit on your personal situation. And as I said a moment ago, the problem with bonds today is that interest rates are so low. So in the old days, bonds, when they were paying 6, 7, 8% coupons, then that was a pretty nice return in and of itself. But now the total bond market index fund pays something on the order of 2.5%, 2.75%. VTSAX, the total stock market index fund, pays dividends of just under 2%. So bonds today no longer have much of an additional income boost from interest as opposed to dividends on stocks. So you mostly have them today in your portfolio to provide that stabilizing effect against the volatility of stocks.
Yeah, that's perfect, Jim. I know I've been harping on that. Thanks for kind of helping me piece those together. Frankly, I think sometimes it comes down to the fact that it almost just seems too simple, right? You want a more complex answer, but frankly, again, it goes back to the idea that simplicity is power, and being a little bit contrarian with some of these questions, I think will help me personally, but also our audience latch onto these concepts and understand that they stand up to inspection. I think that after we work through all these individual pieces like allocation, the one thing that kind of stands out that I'd like to see discussed, and I believe this is actually going to set us up for a question from Amber from our Facebook group, was this idea of fixed income. People talk about things like annuities and all these other fancy vehicles, maybe even reverse mortgages to provide fixed income and the value of just having set income. But we haven't really talked about that in the context of saying that just index fund investing. I'm just wondering, in your mind, as a financial planning tool and as an alternate vehicle, do those fit inside the FI universe at all? Is there any place for them? Are they something that you consider or that you've talked about in your blog at all? Dum, dum, dum. And if you want the answer to this controversial question, as well as others from our Facebook group, we will be featuring them in an episode that will be released in 2 weeks. Same bat time, same bat station. We'll see you next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.